Okay, let's start. So we'll continue the last class, but before we continue, let's get a quick review about the last class. What was discussed in the last class? So basically, in the last class, I said in this chapter, the calculation is not intensive. Instead, you'll be required to understand some key concepts, including, first of all, let's see. First of all, decentralization. Why companies I should mention that this chapter is responsibility accounting and performance evaluation. So in the last class, we learned what responsibility accounting is, and in today's class, we will learn some methods to evaluate the performance of a subunit of a company. Well, I just mentioned a subunit. So when do you see the subunits in a company? When the company grows, becoming decentralized companies. Well, so here you need to remember what is decentralized companies. So again, decentralized companies split their operations into different segments, such as departments or divisions. So in decentralized companies, top management delegates the decision-making responsibility to segment managers, and top management determines the type of decentralization that best suits the company's strategy. Well, we also learned some advantages of decentralization, including frees top management time, supports use of expert knowledge, improves customer relations, provides training, and improves motivation and retention. Also, we learned some disadvantages of decentralization, including duplication of cost and goal congruence. Well, in the later part of this chapter, we will learn some strategies to solve this issue. Goal congruence. Well, we also discussed the responsibility center. 4 types: cost center, revenue center, profit center, and investment center. Well, for each center, a responsibility center means that in this part of the subunit or divisions of the company, this part or the manager of this division is only responsible for one thing, either cost, revenue, profit, or investments. Well, for example, in cost center, the manager is only responsible for computing the cost, being regardless of anything else. The manager of a cost center doesn't care about the revenue. Rather, in profit center, the manager of a profit center considers both cost and revenue, because the goal of the manager of the profit center is to maximize the profit. Well, but in the investment center, the manager is responsible for generating profits and efficiently managing this department's invested capital. Well, in the second part, we learned how to describe the purpose of performance evaluation system and how the balanced scorecard helps the company evaluate performance. Well, a performance evaluation system is a system for top management to use as a framework to evaluate and control the entire organization. Several goals for a performance evaluation system. Also, some limitations of financial performance measurement. Well, considering the limitations of financial performance measurement, we switched to seeing some non-financial part. A prevalent strategy to look at the performance is called balanced scorecard. Well, here, this word, balanced, is important because the managers of company looks not only the financial performance, but also some non-financial performance indicator of a company. For example, in balanced scorecard, the companies look at 4 different perspectives. The lowest level is financial perspective, but in addition to that, we still have customer perspective, internal business perspective, learning and growth perspective. To evaluate the performance of each different perspectives, we use common key performance indicators, or KPI in short. Here is a table listing all the different KPIs for performance evaluation within different perspectives of the company. So we will continue on the next part. So in this part of the chapter, we take a more detailed look at how companies measure financial perspective of a balanced scorecard for different business segments of the company. Now we focus on the financial performance measurement of each type of responsibility center. Well, before we learn the difference between evaluation performance in different responsibility centers, we should know 2 more things. They are responsibility center, responsibility reports, and controllable versus uncontrollable costs. Well, first of all, responsibility reports. This is a report that is used to evaluate the performance of a specific responsibility center. So responsibility reports are performance reports that capture the financial performance of cost center, revenue center, or profit center with a focus on responsibility and control. You should remember that performance reports compare actual results with the budgeted amounts and display a variance, or in other words, a difference between actual and budgeted results. Because cost centers are only responsible for controlling the cost. Their performance report includes only information on actual cost versus budgeted cost. And likewise, performance reports for revenue center contain only actual revenue versus budgeted revenue. However, for the profit center, as you may recall, profit center is responsible for both controlling costs and generating revenue. So their performance reports the actual both the actual and budgeted information on both their revenues and costs. A unique factor of responsibility reports is the focus on responsibility and controllability, because the responsibility reports are used for performance evaluation. The focus is only on what the manager has responsibility for and control over. So it is not logical to evaluate a manager on items this manager cannot control or is not responsible for. So I just mentioned some parts that cannot be controlled by the managers. This part is called non-controllable cost. So let's take a detailed view of what is controllable cost and what is non-controllable cost. So a controllable cost is one that manager has the power to influence by his or her decision. All costs are ultimately controllable at the upper level of management, but controllability decreases as responsibility decreases. Well, that means lower level management has responsibility for a limited amount of costs. Responsibility accounting tries to associate costs with the manager who has control over the cost. Results are shown on a responsibility report. So responsibility reports are prepared for each segment of business. So it is sometimes complicated for the managers of each segment. Performance here, the performance report includes all expenses the segment manager may or may not be able to control. For example, allocated corporate costs are included in the performance report, but they are not controlled by the segment manager. Responsibility reports only include expenses that the manager has control over because these reports are used to evaluate the performance of the segment manager. If the manager of that division cannot control the cost, it is not included in the responsibility reports of that division. For example, allocated corporate costs are not included in the responsibility reports. So let's take a look at the responsibility report of the cost center. Well, cost centers responsibility reports typically focus on flexible budget variance. That is the difference between actual results and the flexible budget. You may recall that a flexible budget uses standard costs at the actual level of activity. So the flexible budget variance highlights the difference caused by changes in costs, not by changes in sales or production volume. Well, this slide shows the difference between performance reports and responsibility reports for a cost center using the payroll processing department of our example company, Smart Touch Learning. Because the payroll process department only incurs costs and does not generate revenue. This department is classified as a cost center. The performance report shows all costs incurred by the department, including the salaries, wages, and payroll benefits, equipment depreciation, supplies, and other expenses. Well, here you may ask such a question. What is the difference between a salary and wage? What's the difference between salary and wage? Well, the difference is that salary is paid by a constant period, for example, 1 year. That means, well, I said a salary amount for you within this year. No matter how many times you spend on the work, this part of money is constant to you, is fixed part. For example, some higher level managers in the company get salaries. No matter how many hours they spend on their work, they get this part of fixed salary. Instead, wages are based on hours. The more hours you worked on, the more wages you get, and vice versa. Less hours you work on, less wages you get. The example is the lower level workers. For example, the delivery guys, the food delivery guys, they get wage based on the hours they work on. 1 hour, for example, $10. If you work 2 hours, you get $20. If you do not work today, well, you get nothing. So this is the difference between salary and wage. Well, this report is useful when management needs to know the full cost of operating the department. For example, if this company is considering outsourcing the payroll function and eliminating this department, then the management needs the full cost information to make such decision. Because this type of decision is covered later in the short-term business decision. But if the company wants to evaluate the performance of the department manager, then the responsibility report is more useful. So if you make a comparison, well, if you make a comparison, let's see. In the responsibility report, salary is not included. Wage is included. Payroll benefit is not included. Yes, payroll benefits is not included. Equipment depreciation is not included. Supplies, yes. Other expenses, yes. So let's explain the reasons. For salaries, it is not controllable for this cost center because the department manager doesn't control his or her own salary. Payroll benefits. This is also a part not controllable by the cost center's manager. Some other payroll costs, such as the payroll tax, this part is determined by law, and also are not controlled by the department manager. And lastly, let's see the equipment depreciation. Well, the department manager doesn't have the authority to make investment decisions. So cannot hold responsible for this part of cost, depreciation. Managers use management by exception to determine which variants in the responsibility report are worth investigating. Management by exception directs management's attention to important differences between actual and budgeted amounts. For example, management may investigate only variances that exceeds a certain dollar amount or the numbers exceeds a certain percentage of budgeted figure. But this is arbitrary. So you may ask, what dollar amount or what part of percentage is the exception? Well, it depends. It really depends. Depends on, for example, the size, the age, the total revenue, many factors of the company's operation. So next, let's see the responsibility report of a revenue center. Revenue center responsibility reports often highlight both the flexible budget variance and the sales volume variance. The responsibility reports for premium tablets sales departments of the company might look similar to these slides, with detailed sales volume and revenue. So this is basically very similar to what we learned in the last chapter. It shows the difference between actual sales, budgeted sales, standard budgets, and flexible budgets. Okay, let's see profit centers. Well, managers of profit centers are typically responsible for both generating revenue and controlling the cost. So their performance reports include both revenue and expenses. This slide shows an example of a profit center performance report. Notice how this profit center performance report contains a line called traceable fixed expense. This part. Traceable fixed expenses. You may recall that one of the drawbacks of decentralization is that subunits may duplicate costs for assets. Many companies avoid this problem by providing centralized service departments where several subunits share the assets or costs. For example, here, the payroll processing cost center serves all of the company. In addition to a centralized payroll department, the company often provides centralized, for example, human resource departments, legal departments, or information system departments to avoid such problem. When the subunits share centralized services, management must decide how to allocate these costs to various segments that utilize their services. If the costs are not allocated, the subunit's performance report will not include any charge for using those services. But if they are allocated, the performance report will show a charge for traceable portion of those expenses. But keep in mind, even if the department is charged for the services, the charge would most likely be included in the department performance reports, but not be included in the department's responsibility report. Responsibility accounting holds the manager with the most influence for the cost accountable for the cost. Manager, in this example, for the standard tablet department, would most likely not have any control over cost decision made for the payroll processing department. So this is the slides that showing the responsibility report for this subunit. So you can see in the responsibility report, traceable fixed expenses are not included. So next, let's learn some KPI, key performance indicators, to evaluate the investment centers. They are ROI and RI, return on investment and residual income. Well, investment centers are typically large divisions of a company. The duties of an investment center manager are similar to those of a CEO. The CEO is responsible for maximizing income in relation to the company's invested capital by using company assets efficiently. Likewise, investment center managers are responsible for not only generating profits, controlling costs, but also making the best use of the investment center's assets. For example, an investment center manager has the authority to open new stores or close existing stores. The manager may also decide how much inventory to hold, what types of investments to make, or how aggressively to collect accounts receivable, etc., etc. So, in other words, the manager has decision-making responsibility over all the center's assets, both current or long-term assets. Well, companies cannot evaluate investment centers the way they evaluate profit centers, based only on operating income, because operating income doesn't include how efficiently the segment is using its assets. So the evaluation of investment center must include two factors. First, how much operating income the segment is generating. And, well, the most important one, how efficiently the segment is using its asset. So let's continue considering this example. In addition to tablet computer division, the company also has an e-learning division, which makes software. Operating income, average total assets, and net sales revenue for two divisions. For July, it's shown as follows in this slide. Operating income, average total assets, and net sales revenue. Well, this information is given. So, first of all, let's take a look at ROI, return on investment. Well, return on investment is one of the commonly used KPI for evaluating an investment center's financial performance. ROI is a measure of profitability and efficiency. To measure the profitability, we use this indicator, operating income. To measure the efficiency, we consider another factor, that is average total assets. So operating income divided by average total assets. We can look at the efficiency of the usage of the assets of a company. Well, not only company, but also some organizations. Any organizations. Well, for example, a university. Well, let's look at so well, let's look at this. This is the official news from our Rutgers Business School. And you can see Rutgers Business School ranks among business schools with the best ROI. And I can remember a poster at the entrance of our business schools building. It says #1 ROI for a public business school in well in some regions. Well, that means our business school, Rutgers Business School, makes the best efficiency of average assets. Well, that means a higher ROI means a very high amount of operating income and very low amounts of average total assets. Or in other words, our business school, well, uses the school's assets efficiently. In terms of this point of view, we can say, well, Rutgers Business School is a very good investment center. And our dean is a good manager of an investment center. Okay. Let's see. This example. So again, ROI measures the amount of operating income an investment centers earns relative to the amount of its average total assets. The ROI formula focuses on how well the average total assets were utilized to generate operating income. Okay, in this example, each division's ROI is calculated as follows. E-learning division's ROI is 18%, and tablet computer division's ROI is lower, which is 15%. So what does it mean? It means although that the tablet computer division has a higher operating income, the tablet computer division is actually less profitable than the e-learning division when we consider that the tablet computer division doesn't utilize its average total assets as efficiently. Well, in addition to comparing ROI across divisions, the management also compares the division's ROI across time to determine when the division is becoming more or less profitable in relation to its average assets. Additionally, management often benchmarks divisional ROI with other companies in the same industry to determine how each division is performing compared to other competitors. To determine what is driving a division's ROI, the management often restates the ROI equation to uh, an expanded form. So in addition to ROI, we will learn some two additional indicators. They are, first of all, the profit margin ratio. In addition to profit margin ratio, we will also look at asset turnover ratio. Well, first of all, let's explain the first one. Profit margin ratio. The net sales revenue is incorporated in the denominator of the first ratio and in the numerator of the second ratio. So when these two ratios, profit margin ratio and asset turnover ratio, when these two ratios are multiplied together, as you can see, the sales revenue cancels out, leaving the original ROI. So, first of all, the profit margin ratio shows how much operating income the division earns on every $1 of sale. So this term focuses on profitability. And the calculation is shown in this slide. For e-learning divisions, the profit margin ratio is 6%. For tablet computer division, the profit margin ratio is 19%. So that means for the first division, this department earns operating income of 6 cents on every $1 of sales. For the second department, it is able to earn operating income of 19 cents on every $1 of sales. Asset turnover ratio is the second part to of the expanded ROI equation. Well, this ratio shows how efficiently a division uses its average total assets to generate sales. Rather than focusing on the profitability, this ratio focuses on efficiency. And the calculation of asset turnover ratio for each division is calculated as follows. For e-learning division, the asset turnover ratio is 3. And for the second division, the tablet computer division, the asset turnover ratio is only 0.81. So this means e-learning division generates $3 of sales with every $1 of average total assets. And on the other hand, for tablet computer division, that means it generates only 81 cents of sales with every $1 of average total assets. So we can say the e-learning division uses its average total assets more efficiently in generating sales than tablet computer division. As you can see, the expanded ROI equation gives management more insight into the division's ROI. Management can now see that the tablet computer division is more profitable on its sales than the e-learning division. But the e-learning division is doing a better job of generating sales with its total assets than tablet computer division. So in this case, the e-learning division has a higher ROI of 18%. But if managers are not satisfied with their division's asset turnover ratio, what can they do to improve it? Well, they might try to eliminate non-productive assets, for example, by being more aggressive in collecting accounts receivable, by decreasing inventory levels, or by disposing of unnecessary plant assets. Or they may decide to change the retail store layouts to increase sales. But what if the management is not satisfied with the current profit margin ratio. To increase the profit margin ratio, management must increase the operating income earned on every dollar of sales. Management may cut product costs or selling and administrative costs, or it needs to be careful when trimming these costs. Cutting costs in short term can hurt the long-term ROI. For example, sacrificing quality or cutting back on research and development could decrease costs in short term, but may hurt the long-term sales. The balanced scorecard introduced before helps the management carefully consider the consequence of cost-cutting measures before acting on them, because the company needs a more balanced performance on each of the four perspectives. Okay, the second indicator, residual income. This is another commonly Residual income is another commonly used KPI for evaluating an investment center's financial performance. And similar to ROI, ROI considers both divisions' operating income and average total assets. ROI is used to achieve goal congruence better than ROI. So let's take a look at of its formula. RI equals to operating income minus minimum acceptable operating income, where minimum acceptable operating income is calculated as target rate of return times average total assets. Well, you may ask, how much is target rate of return? This part. Well, I could say this is also an arbitrary ratio determined by top management. So RI compares the division's actual operating income with the minimum operating income accepted by top management. It is the actual operating income above the minimum operating income. So a positive RI means a division's operating income is greater than management's target rate of return, and vice versa. A negative RI means the division is not meeting the target rate of return. So let's look at the RI for each of these two divisions in this company. For e-learning division, the RI is positive 50,000. For the second division, the RI is negative $64,200. So, as I said, a positive RI indicates e-learning division has a greater operating income expected by top management. So in terms of RI, e-learning division is performing better than the other division. So this is a summary of return on investment, and this is the slide showing the summary of residual income. Also, there are some limitations of financial performance measures. First limitation is measurement issue. And second one is short-term focus. Well, a company may prefer to use RI over ROI to evaluate the performance because RI is more likely than ROI to lead to goal congruence. Recall that total asset is a balance sheet amount, which means that it is a snapshot at any given point in time. Because the total assets amount will be different at the beginning of the period than at the end of the period, most companies choose to use a simple average of the two amounts in their ROI and RI calculations. Not all assets are used in ROI and RI as non-productive assets may skew the ROI and RI results. One serious drawback of financial performance measure is their short-term focus. Companies usually prepare responsibility reports and calculate the ROI and RI figures over a 1-year frame or even less. If upper management uses a short time frame, division managers have an incentive to take actions that will lead to an immediate increase in these measures, even if such actions may not be the company's long-term interest. So lastly, let's take a look at transfer price. What is that? Basically speaking, the transfer price is the transaction amount of one unit of goods when the transaction occurs between two divisions within the same company. Well, the primary objective in setting a transfer price is to achieve goal congruence by selecting a price that will maximize overall company profits. And the secondary objective is to evaluate the managers of the responsibility center. So, for example, in Smart Touch Learning, one company that is the tablet computer division, one division that is the tablet computer division is responsible to produce the hardware of the tablet computer. But the computer needs to be loaded with software such as the operating system, which is produced in another division, e-learning division. So the manager of tablet computer division needs to make a decision to that if the software should be purchased outside or within the company from another division of the company. Well, here an important assumption is that if the manager decides to outsource the software purchase from outside vendor, the price, the maximum price is same with outside market price or internal price. So you can regard this issue as a problem of two quote-unquote companies or two sub-companies within a big company. So basically, this is a rule to set the transfer price. A transfer price can be in a range that extends from variable cost per unit and outside market price. So, as you may recall, that the variable cost of the software is $60. So here let's assume the market price of the software is $100. So the transfer price should be set between $60 and $100. So let's imagine the transfer price is less than $60. What does it mean? That means the more software you sell, the worse the performance is the manager of e-learning division. But if the e-learning division sets the price higher than the market price, the tablet computer division would outsource the purchase of software from outside the company, from outside market. So the negotiable range is between 60 and 100. Or in other words, between variable cost and market price. The contribution margin range is the negotiable range. So, two more concepts. Operating below capacity and operating at capacity. Oh, plus Well, if the selling division is operating at capacity, it is producing and selling all the courses. It is capable without expanding the facility and adding more employees. In this case, the division has to make a choice about whom to sell to customers outside the company or to an internal division. Because the internal division has a choice of customers, the transfer price should be at market-based transfer price. The market-based transfer price is a transfer price based on the current market value of the goods. If the e-learning division sells for less than a market price, then it will have a decrease in contribution margin, and company profits will decrease. The lost contribution margin becomes an opportunity cost for the division. Okay, here an opportunity cost is the benefits given up by choosing an alternative course of action. And another case is operating below capacity. If the e-learning division is operating below capacity, then it should be willing to sell courses to the tablet computer division at any amount equal to or above the variable cost, which is $60. Selling at any price above $60 will increase more contribution margin for the division to help cover the fixed cost and therefore increase the profit. A cost-based transfer price is a transfer price based on the cost of producing the goods. Okay, so this is the end of this class and also the end of this chapter. Do you have any questions? We will start a new chapter, which is chapter 25 in the next week.